So, hello guys and welcome again. So, as I've promised earlier, I have here the transactions that we are going to analyze. Okay? So, first, we need to identify if these transactions are accountable. And after that, we will see or we will have the effects in the assets, liabilities, and capital of the transactions, of those transactions. So, let's start. Letter A. So, this particular sequence of transactions are starting from simple transactions to a much more challenging. So, there are no difficult transactions here, only challenging. Okay? So, let's have letter A. But before that, on November 1, 20x2, BBG Company started its operations and had the following transactions for November and December. Okay? Now, letter A. The owner or the investors invested 100,000 to open the business. So what is that? Is that an accountable transaction or not? The correct answer is it's an accountable transaction because it affects the assets, liabilities, and capital. Okay? Now, let's move to the second part. Aside from identifying, part 1 is identifying if this is accountable or not. Part 2, what are the specific effects on the assets equals liabilities plus capital? Of course, the assets of the company will increase. Our entity's assets will increase because the owner invested cash. Okay? So that's the effect on letter A on the assets. But of course, let me tell you that when it comes to bookkeeping and accounting, there are actually at least two effects. Okay? Because if ever we're just going to register 100,000 in the assets, of course, this particular equation will not be true already. The assets is not equal to liabilities and capital already. So there are at least two transactions. So, two transactions. One transaction has at least two effects in the A is equal to L plus C. Okay? Now, what's the second effect? Since I've already told you that if ever the owner invests in the company, there will be a somewhat an obligation of a business to its owners, and it's always listed in the capital account, the investment of the owner. So that's the effects, the actual effects of this particular transaction. So is it balanced? Yeah, it's balanced. You follow? Now next, we have business permits and licenses paid 2,300. Of course, since there is a payment of 2,300 on transaction B, the assets will be decreased. But what type of asset? Of course, money. Actually, this number 1 and number 2 talks about inflow of money, and this one is outflow of money. Gets? Now, again, there are at least two effects in the transaction. Okay? Now, business permits and licenses are usually considered as expenses. Okay? It is because the business permits and licenses grants you a right to conduct business normally for 1 year only. So, it's for short term, which is normal in accounting or bookkeeping. It should be recognized as an expense. Unless the right that has been granted to you is for long terms. Because, for example, if you have been given a right, a permit, a license that you could use for 5 years, then that would mean this 2-3 will become an asset. Okay, so what will happen is this 2-3, the cash will be diminished or decreased, but there will be another asset, which is what do we call as uh, intangible asset, a permit. And that particular asset will become an expense bit by bit for 5 years. If the permit is going to give you a right or license to operate or license to have something, so if it is for 5 years, as what I've said in the example, this 2, 3 will bit by bit be diminished or decreased for 5 years. So divided by 5, and it will become an expense because it will expire. But in this case, since our business permits, or what do we call as mayor's permit here in our country, is only being used in 1 year, then let's consider this as an expense. So again, since you paid, the assets will be decreased 2,300. But what about the expenses? Where will you put the effect on the expense? Because I've said that's an expense. It will not be here in the assets. It will not be here in the liabilities also. It is in the capital. Okay? As an expense. Because again, if there are revenues, that will be given to the owners as their benefit that they have to enjoy. But if there are expenses also, they are the ones to burn the risk also. So, is the equation still balanced? Yes. Of course, 100 minus 2, 3, 100 minus 2, 3, the equation is still balanced because the liabilities is still 0. Okay? So, that's letter B. And we have letter C. Rent for 5 months, which is 3,000 per month, was paid in advance at the beginning of November. So at the beginning of November, you have paid your landlord or the landlord of the entity 5 months rent, 3,000 per month. So that's about 15,000. Okay? Now, this is what do we call as prepayments or deferred assets or deferred expenses. Deferred expenses, from the word deferred, it is not yet an expense. So deferred expenses, not yet an expense. It is because you have paid for something that you have not consumed the benefits yet. So, deferred expenses or prepayments are considered as assets and not as expenses like this. You follow? Because again, you have paid in advance for renting something which you have not consumed yet. You have not stayed for the place yet because it's paid in advance. Okay? So again, that is what we call as prepayments or deferred expenses. Your advance payments to someone in which that advance payment, that means you have not yet consumed any benefit. You have not used the what should be used. Okay? The benefit has not yet expired, then that is what we call as deferred expenses or prepayments. So what do you do for this one? Of course, what will happen is, in letter C, you have to recognize the decrease in cash because you have paid in advance. It's not 3,000, it's 3,000 per month, so that means it's negative 15,000. Take note, these are all cash. Cash, cash. Why do I have to emphasize that they're all cash? Because again, as I've said, there are many types of assets. So a company can have a lot of assets and one of those assets is only cash. So that is only one example of assets. A company can have a lot of types of assets. Okay? But there is one reason why I emphasize that. It is because there will be another asset that will be added in the assets. There will be a cash. There will be a decrease in asset by means of what do we call this? Decrease in cash. But there is an asset. This is what do we call as prepayments. And again, the other name for this one is deferred assets, where you pay in advance to a customer, to a supplier or to someone without using yet the benefit. So that is a temporary asset only. Deferred assets, deferred expense. Now, before we go to letter D, as you have noticed, the first one, the assets increased, the capital increased because of the owner's investment. That is what do we call as source of assets. The transactions, as well as their effects, there are some, what do we call this, aliases. In this case, assets increased, the capital increased. This is what do we call use source of assets. So it could be like this, or it could be that the entity will borrow something or will avail a loan from a bank. So what will happen is this will increase and the liabilities will also increase. That is still a source of assets transaction. Okay? How about the second one? The second one is what do we call as use of assets. Because the assets were decreased because of an expense. So that is a use of asset. Okay? Again, this is an example of use of asset. Okay? Now, let's have letter C. As you can see, one of the assets increased, the prepayment and the deferred expense, and the other asset decreased in the form of cash. This is what do we call as exchange of assets, where an asset were given up or an asset was given up in order to get a new asset. That's exchange of asset. Okay? So that's letter C. Now let's go to letter D. What happened to letter D? Supplies were purchased for 20,000. So, of course, as I've said, supplies are considered as assets like bond paper, tissue paper, and etc. So that's increase of 20,000 in the assets. But there is a twist. What is that? 10,000 was paid in advance or down payment. We call that down payment. And then the rest were paid after 2 months. So after 2 months only. So what are we going to do with that? So after 2 months, that would be, November and December. After December, it will be paid after 2 months. So it's to be paid on January. So the 10,000 was paid now, but the other 10,000 will be paid on January of the next year. Okay? So initially, how are you going to record that? Again, the supplies, there will be an increase of 20,000 in the form of supplies. However, there will be a decrease of 10,000 in the form of cash. So this is partly exchange of asset, right? However, it is not yet balanced. It is not like this one because the prepayment is 15 and the cash decrease is 15 also. So that has been offsetted. So in this particular transaction, letter C, the A is equal to L plus C is still balanced, right? How about this one, the letter D? It's not balanced, of course, because 20,000 increase and there is only 10,000 decrease. So what will happen? Again, the 10,000 was paid in advance, but the rest will be paid in January of the next year. So where will we put it? Of course, we're going to put it here on the liabilities because it is assumed that the supplies were taken from suppliers which are considered also third parties. Okay? Now, let's go to letter E. Letter E. What happened to letter E? There is an office equipment that was purchased for 30,000. Of course, similar to letter C, this is an exchange of asset. 30,000 in the form of office equipment. Yep, office equipment. But you have to pay cash in order to acquire that office equipment. And that's it for letter E. And as you have noticed, even if it has not been mentioned that the equipment was purchased for cash, actually it's silent. If ever the problem is silent, then you assume that the asset was acquired for cash. which is why this is the effect. Okay? So that's letter E. I'm sorry, I'm checking if ever everything was recorded. Now let's go to letter G. Now on letter G, utilities paid for 2 months is 19,750. Utilities expenses are those water bills, electricity bills, or those things that you are paying for things that you have already enjoyed, things that you have already extracted benefit from. So if that will be the case, there will just be a decrease of 19,750 in cash, and the partner of that one is negative 19,750 in the capital because of expenses. Because expenses will decrease your obligation from your owners because we are the entity, as well as the withdrawal of the owners will decrease our liabilities from the owner. So that's letter G. Okay? Now let's go to letter H. On letter H, there are 3 clients who paid professional fees for 5 months in advance. So that's 80,000. And then if we are going to divide 80,000 by 5 months, so 80,000, 8,000, if we're going to divide it by 10, so 16,000 per month. The professional fee is supposed to be 16,000 per month. But the 3 clients, okay, let's lump. So 16,000 for 3 clients per month. Okay? That's it. So that's 80,000 divided by 5 months. So these 3 clients should have paid, if ever they have not paid in advance, they should pay for every month 16,000. Okay? So now, before we go further, this is what do we call as deferred revenue. So it's not yet a revenue. Why? Because you have been paid in advance, right? But you have not given yet your services. You have not given yet any goods if you are selling goods. In this case, you have not given yet your professional service. Okay? So it's not yet a revenue. You cannot put it here happily in the capital as revenue because again, you have not yet uh, given your professional services. So basically, that is your liability. Okay? You have received something that you don't still deserve. Do you follow? So if that will be the case, again, this is what do we call as deferred revenue or unearned revenue. Okay? So basically, what will happen is, you will receive the cash, of course. Who does not want an advance payment? So you are going to receive cash, 80,000. But then again, since it is not yet a revenue, because you are still indebted to those clients, however, you're not going to pay them money. Instead, you're going to pay them professional services. Then you have to put it in the liability side. That is what do we call as unearned revenue. So unearned revenues or deferred revenues are liabilities despite of the wordings revenue and revenue. Even if in their names they have the word revenue, they are not revenue because of the words deferred, not yet revenues, unearned revenues. So this is part of the liabilities. So that's 80,000. Before we go along, let's go back to letter D. As you can see, there is an increase of 20,000. There is a decrease in cash. So that is already 2 entries, right? But I've said earlier that the entries in the A is equal to L plus C is at least 2. So as you can see here, there are 3. 20,000 minus 10,000 minus 20,000 minus 10,000 and another 10,000 here in the liabilities. So there are cases just like that. Sometimes it's more than 3. Okay? But I am going to emphasize At least there should be two effects so that the A is equal to L plus C will still be balanced. Okay? Now, going back, we have letter I. Letter I, other clients paid 40,000 for services that you already rendered. So this is not the same with letter H because you deserve this already. Okay? So if that will be the case, since you deserve it already, 40,000 will be increased in your assets because you have received cash. Okay? Now, since you have earned that already, it will become a revenue, 40,000 here in the capital portion. So again, any good thing that will happen to the business will be credited to the owners because they are the ones who are taking all the risks. So supposedly, on the benefits, they should also enjoy. And this is one of those cases. The revenues they enjoy, the expenses they suffer. Okay? Now, let's move forward. Let's go to letter J. The owner withdrew 25,000 for personal purposes. So if that's the case, there will be a decrease of 25,000 cash because the owners took it. And of course, since that is a withdrawal, there will be a decrease of 25,000 here in the capital side because of withdrawal. So that's it for letter A to letter J. That's the easy part. Okay? Now, let's go to December 31, 20x2. The following information are added for adjustments. Sometimes, these are initial entries only. There are still follow-up entries so that these entries here will be updated. Okay? So these are what do we call as adjustments. Okay? So, number 1, rent for 2 months has already expired. So, if you can still remember, here in the letter C transaction, you have paid rent in advance for 5 months, which is 3,000 per month. So, what we did in letter C, we recognized it as an asset here because we have not yet consumed the benefit of that particular payment, the 15,000. However, 2 months have already passed in December 31, 20x2 because the rent for 5 months was paid at the beginning of November. So November, December, 2 months has expired. So of course, you have to record also what has expired. So since there is 3,000 per month, so 3,000 plus another 3,000, we have 6,000 which has expired. You have to recognize that. So this 15,000, you will be deducting it with 6,000 because it's not already an asset because it has already expired. And you will recognize that here in the capital as an expense. So see, the adjustments here will make you update the amounts that you have recorded at the very beginning. So that's the purpose of adjustments. So that's normal. This is normally the entry for prepayments. There is an asset. However, upon adjustment, that particular asset will decrease by the expired portion and it will go to expense. And as you can see on number 1, it's still balanced because if the assets will decrease and the capital will also decrease, then the A is equal to L plus C. We are hoping that it will still be balanced at the end. Okay? So that's adjustment, number 1. Let's go to number 2. So supplies on hand is 3,500. So if you remembered, we paid for supplies. We bought supplies, letter D, for 20,000. We do not care if ever there is a down payment of 10,000 only and the 10,000 will be paid next year. We do not care about that. The point is, we focus on the supplies. The supplies that we purchased is 20,000. That's our asset. That's on letter D. But then again, according to the adjustment, adjusting information, you have to adjust the supplies because the supplies on hand is only 3,500 worth of supplies only. So from 20,000, it's as if the 16,500 has already been used because the unused is 3,500. You have purchased 20,000. So analytically or logically, we can conclude that 16,500 has been used already. So if that will be the case, you have to deduct here 16,500 and you forward it to expense 16,500. Okay? So that's number 2. Now let's go to number 3. So number 3 is talking about the office equipment. If you can still remember, we have letter E here. We have purchased an office equipment of 30,000. So what we did is we put here an increase in asset in the form of office equipment 30,000. And we paid for 30,000 cash. So that's an exchange in asset. But let's not focus on cash. Let's focus on office equipment. So what I would like to tell you guys is that equipments, machine, building, except for land, those assets are temporary. Although they can be used for a lot of years, there will come a time that they will be unserviceable or unusable or damaged or destroyed. Okay? Because of too much use or because of passage of time or because of physical wear and tear. You understand? So if that will be the case, let's read number 3. Office equipment's life is 5 years. And the salvage value is 500. Let's ignore that 500 yet. Let's have the office equipment's life is 5 years. So it is assumed that if you buy the office equipment now, after 5 years, it will become unusable or destroyed because of physical wear and tear. Okay? So that means the 30,000 should be decreased also bit by bit every year. Okay? So, for example, if the office equipment is 30,000 based on letter E, since its life is 5 years, you divide that by 5. So 30,000 divided by 5, then you have 6,000. Right? So it means 30,000 divided by 5. Every year of usage of that equipment, 6,000 will become an expense. And that's what do we call as depreciation expense. So it will start at 30. After 1 year, it will now be 24. After the second year, it will become 18. Until at the end of the 5th year, it will become 0. Okay? Do you get me? Unless there is a salvage value. Salvage value is that it's a proceeds that you're gonna get if ever the destroyed item can still be sold to, for example, scrap yards or junk shops, something like that. That's what we call as salvage value or scrap value. So if that will be the case, the 30,000 will not be the ones that will be divided by 5. Instead, you have to deduct the salvage value from the 30,000. So meaning, only 29,500 will be subjected to depreciation. That is what we call as depreciable amount. Depreciation is actually the opposite of appreciation. So that means, on the 30,000, based on this particular adjusting information, from 30,000, the lowest value that it will attain, the office equipment, is 500. So meaning, the amount that will be decreased over its life is only 29,500. So that is the meaning of depreciable amount. The amount of decrease that will happen over the life of the office equipment or the non-current asset is what we call as depreciable amount. Okay? So if we do that, 29,500 divided by 5 is 5,900. So meaning, after 1 year of using 30,000 minus 5,900, okay? After the 2 years of using of the office equipment, then 30,000 minus 5,900 minus 5,900. So the remainder will become the remaining value of the office equipment or the book value. So that is the meaning of that. Okay? So that's depreciation. Okay? Now, let's talk about the problem here. The problem here is that we can use the 29,500 already. That's 30,000, which is the historical cost of your office equipment in letter E. That's what we have recognized here. Minus the salvage value, that's 29,500, divided by 5. So the depreciation expense per year is 5,900. However, in this particular example, we only have 2 months. So instead of having 5,900, you have to put here times 2 months over 12 months. So 5,900 times 2 divided by 12 months, that's 983.33 only. So meaning, on number 3, the office equipment will be decreased by 983.33 because of depreciation, and 983.33 here because depreciation is an expense. Okay? So that's the result of the adjusting information number 3. Now let's go to adjusting information number 4. Salaries incurred but unpaid is 3,000. So what is the meaning of this? There are some employees of our entity who has already served the company, for example, for 5 days, but you have not yet paid them. Okay? So meaning, this particular salaries, you have already used the benefit, and that is the services that have been rendered by your employees. So you have already incurred. That's the meaning of incurred. You have already enjoyed the benefits, but you still did not pay. Okay? So that is 3,000. That is what do we call as accrued expenses. So accrued expenses are those expenses that you have already enjoyed the benefits, but you have not yet paid. So accrued expense and deferred expense are opposites. The deferred expense is you have paid first before enjoying the benefit. On the accrued expense, you have enjoyed the benefit first before you're going to pay. Okay? So, this is an example of accrued expense. So, what will happen is, first, there will be no effect on your asset because again, you have not paid anything. But you will have an expense because here in accounting, we respect the accrual in which the accrual says you recognize expenses when you incur it or when you have enjoyed the benefits, even if you did not yet pay. Okay? So that's accrual concept. And the second statement from the accrual statement is that you have to record revenues already when you have already earned the revenues. Meaning you have already given services or goods if you are selling goods, even if the customer did not yet pay. So those are what we call as accrued revenues. So those two are the statements in the accrual. So accrual is very much opposite with cash basis because on the cash basis, you will just recognize revenue when you collect from your customer and you recognize expenses when you paid for those expenses. It's not like that. in accounting. We follow accrual. Okay? Again, let me repeat. Accrual concept states that you recognize expenses when incurred, not when paid. And if we're talking about revenues, you recognize revenues when you have earned the revenues already, when you have given the services to your client or customer, and when you have delivered the goods if you are selling goods. Okay? Regardless of the customer paying it. So even if there is no collection yet. Okay? Now again, this number 4, what will happen is you will recognize already expenses even if you did not yet pay under accrual concept. So again, that is expense. And you are going to recognize also liabilities. Liabilities still in the form of salaries payable. So you have your liability, and if you're going to pay it, of course, you will decrease 3,000 here and you will decrease assets here. Okay? But since you did not yet pay, that is the entry only. There is a liability, there is an expense here in the capital. So that's number 4. Now, number 5, that is the ones that I'm talking about, the accrued revenues. The services has been rendered already. If you see these services that you have billed, you're not going to make a bill to your customers if you have not given your part. You have not given your services, you have not given any goods, you're not going to bill them, right? So if you see this, that you have billed your customers, even if the problem is silent, services billed only. Here, it was emphasized that it is unpaid by the customer. Even if there is no mention like this. Services billed, 5,000. It's just like that. It's as simple as that. You recognize that already as a revenue because you have already given your part, 5,000. And you recognize that also as an asset. But it's not cash, it's accounts receivable. Okay? So normally, that is the entry of your accrued revenues, where you have already given your services, you have already given your goods, but you are still unpaid by your customer. So that's accrued revenues again. Okay? Now, let's go to number 6. So this is number 5. Let's go to number 6. 1 month of advance payments from clients in letter H. So as you can see, there are 3 clients who paid 80,000 for 5 months of service. And we have divided already 80,000 with 5 months and we got 16,000, right? So 1 month of advance payments from clients, you have already rendered it. You have already earned that one. Do you get me? So as you can see, what we did in letter H is we considered it as a liability because we have received payments from those clients. Yet we did not yet give give our professional service. That's why it's liability. But then in number 6, since 1 month of advance payments from clients in letter H has already been earned and that 1 month is 16,000, we have to decrease our liability with 16,000. Of course, we have to put here in the capital revenues because you only recognize revenues when you have earned it, when you have given services, when you have given goods also if you are selling goods or inventories. Okay? So, that's how you do it, the transaction analysis. Now, I will not total this. What I want you to do as viewers, you have to comment the totals of this assets, liabilities, plus capital. So, 100,000 minus 2,300. Actually, this open and close parenthesis means minus or negative. Okay? So, 100,000 minus 23 minus 15 plus 20 minus 10. You go on and you get the sum of the effects on the assets. You get the liabilities. and the capital. Okay? And after that, you have to add the liabilities and capital. So you have three things to do. First, total the assets, number one. Number two, total the liabilities. Okay? Number three, total the capital. And then number four, total the liabilities and the capital. And if the total of these two is equivalent to the total of assets, then that's correct. So you have to comment the sum of the assets, liabilities, capital, and the liabilities plus capital. Okay? So thank you for listening and see you on the next episode where we are going to focus already on recording of the transactions. Okay?